focus is on getting the word out as much as possible to people like us that, hey, you can love what you do. You can love being on the road. You can love producing. But we've got an ability for you to kind of pull into as well. Like, let's put some money into what we're doing, into real estate.
You're listening to Alternative Investor Mastermind, where we do a deep dive on alternative investment opportunities and the lifestyle it can create. Join Jack Krupey as he presents actionable tips and tricks in doing passive real estate away from mainstream strategies. Go beyond the usual fix and flips and try less explored yet rewarding investing ventures. From multifamily properties, mobile homes to cryptocurrencies. Do not miss this opportunity to escape traditional assets and finally create wealth without Wall Street. Now your host, Jack.
Hey everybody, welcome to another episode of the Alternative Investor Mastermind. I've got a great guest today, Ben Nelson. Ben and I are in a mastermind together, and he's got a great story, and we're looking forward to sharing it with you and talking some shop on real estate. So Ben, thanks for coming on the show.
Oh, thanks for having me, Jack. It's been a long time coming.
Absolutely. So Ben, you've got a really cool background. So why don't you tell everybody just how you, what you were doing before and how you made the transition into real estate?
Sure. Yeah. So I was a producer for a long time, producing specifically events. Got out of college and was kind of the classic, like, I didn't want to be a grown-up yet and didn't really know what I was supposed to be doing with my life. And so I was able to travel around and really got involved in some small-scale events and decided that that's a path I wanted to take. Picked up all my stuff, all 2 duffel bags worth, and moved to New York City to get outside of my comfort zone as much as possible, just see if I could do it as a profession, and started producing fashion shows of all things. Started at the bottom. I was carrying stuff around. I was the PA and worked my way up. We produced some pretty amazing stuff all the way up to the Victoria's Secret fashion show, but realized that wasn't my space. Got to know a lot of the guys that were more like me, and guys and gals were more like me. I grew up in Durango, Colorado, being outside, being skiing, snowboarding, surfing, being as much outside as I possibly could. So I started producing with the Red Bull guys in New York and worked my way up there as well. So over the years, we talk about niching a lot. I got into a pretty specific niche. We got known for being the people that can kind of pull off some pretty ridiculous, weird, hard things in difficult environments. So we ended up racing race trucks on mountains and, jumping 3 rally cars over each other at once. And it was fun. I loved it. And I still love it. It's one of my favorite places to be, but I also realized it was serving myself. I've got 2 young kids, I've got a family now. And one thing about events, I felt like I was always producing other things for other people, other places. I made the joke like, hey, where do you live? I said, well, my wife and my kids live in Colorado, or my wife and my stuff live in Colorado. And after a pretty long stint in New York City, his last race we produced in Brooklyn, it just came time. I'd been investing, in smaller stuff. My brother and I owned a couple of quads in Texas, things like that. And he had opened shop up in Wild Oak, which is the firm I'm a partner of, and said, hey, really been looking at syndication. I think our skill sets really match this space. Me being an operator already, having the skill set of working with people at a distance, working with, high dollar denominations, not being afraid of getting kind of in the weeds with people and understanding, contracts and what we're trying to do and what we're trying to get done at a large scale, and being able to do that in multiple environments across the country. It really helped us and really matched up well. So we decided that was going to be my last major event on the road. I still produce a little bit here and there. It's just because I can't not. I love it. But our focus is on getting the word out as much as possible to people like us that, hey, you can love what you do. You can love being on the road. You can love producing. But we've got an ability for you to kind of pull into as well. Like, let's put some money into what we're doing, into real estate. Let us show you how you can grow wealth for yourself and your family while you continue doing what you want to do. Not everybody needs to get out of their 9 to 5. Some people love it. But we have the ability to help you grow a lot faster.
Great. And you mentioned Brooklyn, and obviously that was, it sounds like you were putting in a lot of work and a lot of hours, but probably paying a lot of taxes as well, because when it's your primary business and it's not real estate focused, it's active income. Where did you have some painful tax bills?
Oh, I did, man. It's a big part of it too. And it's an ebb and a flow in the event space. So it's feast and famine. When it's good, it's really good. And when it's not, it's not. COVID really knocked a lot of us down for a year.
Yeah, and that's the worst part too, is you have a monster year, you pay almost 50% taxes, but the next year you make nothing, or
right.
You have a rough year, you're not getting your refund from the prior year in most cases. So
yeah.
It's like a damned if you do, damned if you don't type of thing with with taxes if you're not planning properly.
Yeah, you gotta love it.
Yeah, so obviously great time to pivot into real estate during COVID, and you know, it's I guess certainly had to have been a wake up call on that feast or famine and not having passive income, or
It
like
really
maybe not. You
was.
had some, but not, you know, maybe not enough that you could just
Oh, yeah.
you know, sit on a beach.
Well, that's it. I mean, and really having the hard conversations. You sit with my wife and, you know, sharpening the pencil, like how, you know, we're not going to fall down, but we're not going to be in the same position as we were. And, you know, making some smart choices. I think COVID either helped a lot of people or hurt a lot of people, right? Depending on your mindset and your view of it. It really helped us, and it really sharpened my focus on like, hey, this is something that I think we really want to pay attention to. So produced my last event after COVID. Fortunately, we had enough reserves. We had enough people around us that we were able to survive through that. But that's one of those things that like really makes you change and really makes you ask some questions that, you know, this isn't going to be around forever. You know, we're seeing a lot of that right now too, economically speaking. It's not just events, you know, but things that are changing. There's so many people in the syndication space, so many people in the real estate space in general, as you know, that are realizing that, hey, the party that went on for the last 5 years is not the same party that's happening right now.
Yeah, absolutely. And as someone who you know, has scars from 2008 as well, you know, I've had multiple conversations with people that you know, were saying things a year or 2 years ago that I just, in my mind, I was like, I've seen this movie before.
Yeah.
History may not repeat itself, but it does rhyme, and you know, it's really an interesting time where we are right now. But let's talk about the transition. I mean, you obviously you have a partner that was already in the space. You'd already been, you know, you had a foot in real estate. But what steps did you take? Just, you know, day one, you have your last straw moment. You're like, this is it. This is my last.
Yep.
Like, what was the first couple action steps to go, you know, full force into this full time?
The biggest thing is learning, you know, and realizing that a lot of it for me was how adjacent it was to what we were doing already. So understanding, like I said, a lot of that is being capable, asking questions, finding people that know what's going on, finding some mentors. We did already have some real estate along the line, so I'd learned a little bit about that already. Like, it wasn't uncomfortable to me in any case, but it was just realizing that I'm stepping into a much deeper pool here, right? And the consequences are higher, and understanding who around me can help us out. So we met through Hunter Thompson, you know, got involved with his group and understanding capital raising, but really, really digging deep personally into asset management and understanding the why behind that. For me, again, it was a fairly natural transition as far as being able to have really intense conversations, but very pointed conversations with property management companies. What are our expectations? How do we value things? How do we track things? What are our KPIs? All those things, you know. And over time, we'd already had some tough times with property management in our own personal real estate, right? Like, we learned some lessons. We had to fire property management, but a lot of it, I think, going back to what was our fault, and I think I bring a lot of that from the event space, is that a lot of times when things fall down, it's easy to blame other people. But if you have to turn the mirror on yourself and say, hey, what could I have done to make that situation better? What could I have done to avoid that? Or did I even provide enough information? Are they falling down because I'm not providing enough information? Some of that was on us too. So it was the transition of, how do I take what I'm good at? How do I take what I've learned, put it into this space, and then knowing and being very real about what I don't know, and then finding that information.
Yeah, it's a very great point. And for anyone who follows EOS, like for me, I'm a pure visionary. I'm not a natural micromanager. I want to be, you know, the fun sales guy everybody likes and the connector. And it's like not natural for me to really kind of, you know, go through, you know, set all the expectations and the KPIs. I just want to say ready, fire, aim, step 3, step 5, step 7, get it done. So yeah. It's good to surround yourself. You know, every guy like me needs somebody like you who's got the discipline and the operational expertise.
It's funny, man. So there's a lot of those, you know, profile out there. So we took a disc profile a while ago, and in our company, there's actually 4 of us now in Wild Oak. So we took a disc profile, and it's really funny to see how everybody lines up. And mine's a really unique one of like pre-planning. I'm really big on pre-planning, but then I'm also really big on reaction, right? So once I build the plan, I have the ability to pivot. That's just how my brain works, is like figuring out the puzzle pieces of where all this stuff makes sense. And that's the fun for me.
Yeah. So my wife is a CFO of our business, and we had did one of these profiles with the business coach, and my number one execution skill was delegation. And I go, see, honey, it was a funny moment in the thing.
Again.
So what markets are you primarily focused on? Because you live in Colorado still?
I do. Yeah. We live in Golden, Colorado. So just outside of Denver. Grew up in Durango. My youngest brother, actually both my brothers are still down there. My parents are still down in Durango. But for us, we're primarily focused in Texas, Oklahoma, and Arkansas for a couple reasons. We really like the markets, but primarily we really have, especially Texas and Oklahoma, or excuse me, Oklahoma and Arkansas, we have amazing property management partners. There's a lot of talk about vertical integration and bringing things in-house. And I think that that's eventually a step that we'll get to, just because I think that we have the ability to do that. But I would say, more than anything else, a partnership in that realm makes the most sense for us right now. And we grow with the people that are doing a great job. So we're growing, and we're growing rapidly, but we also are recognizing that we can't overstep that. Just because there's a deal to be had in wherever doesn't mean that it's going to pencil. Or even if it does, if we show up and we don't have proper property management there, you can be stepping into world hurt. So we try to grow around the communities that we built. We are constantly assessing new ones. We're constantly having new brokers. Brokers are new in with it, but property management for us is super, super key. So building around those people that we know, we're building into new markets where they're transitioning in new markets. They have new teams, or we'll test things out together, knowing that we have a really great baseline.
That's a really great point. And as I think of our business, it's really same, but different. We follow the operators. We have 10 to 15 different operating partners that each have a few markets, and very rarely are we just investing in a deal. Well, we don't invest in deals cold, where it's just a random email and it's like, hey, come invest in our deal. We're invested with operators that are in markets, and if a good operator that we've made money with expands to a new market and feels they have the team and the property management and the right deal, we'll expand with them. And but from a high level concept, it's really the same model of building the team first. And if you've got the right jockey, you can win with a number of horses, and that's what we focus on a lot too.
Well, it's patience too. Like a lot of people, especially in the early stages of this game, or even as an investor, right? This is a get rich slow game. You can get lucky, and the last couple of years, people have been really able to just throw a dart at the wall and get a little bit lucky. But for us, this is a longer term game, and we see that and we recognize that, and that's the first thing we tell people. And it's even though we say, hey, you don't necessarily have to invest with us. We are so invested in the people that come into our sphere as far as investing is concerned. We have a particular brand, we have a particular way that we do things, we have particular places that we invest in. If you come to us, we're like, I'm expecting 30%, and all these, like, there are people out there that can promise you that. That's not going to be us. Everybody, and I'm sure you've heard a million of these, everybody's like, we underwrite conservatively, or our RGOs are all conservative. And that's something we take really to heart. Everybody's going to say that, but it comes through in the way that we talk to people, and it comes through in our numbers. We aim for the middle. Like, we want something that's really solid, and we know, especially in this term, everybody's predicting 3 years, right? That's where people get into bridge debt and a lot of these other things that people are having a little bit of a hard time with. We are really strong on long-term debt for the most part, and we are really strong on, hey, we plan to stay 3 to 5, but we're fine at 7, and we're great at 10. And coming into this deal, that's what we want you to know. Like, we're not going to fire sell at 3 just to get out because we have to get out.
Yeah, that's an interesting dynamic with investors, and it seems like when you show a 3-year deal, there's a certain level of comfort an investor seems to have that they should have their money back in 3 years. At the same time, most of them don't want their money back in 3 years, or when they get it back, they all of a sudden want to find a new deal immediately. Or worse, if the deal closes in December and they can't find something else to invest in, they may actually have a tax bill. But I think with what we're seeing in the market now, long-term holds are probably the safer bet, long-term fixed rate debt. And, those that locked in, we're in 40 plus deals, and, our deals where we went in with Fannie Mae debt, locked in below 4%, or at 4% in a number of deals. Those are cash flowing like crazy. And we're still getting all the rent appreciation and rent growth as well. Yep. And, I wish, we're in some bridge loans that have a fixed, have a interest rate cap. So, those have a little less short-term cash flow, but overall the rents are still going up through the value add. What level of value add are you when you're looking at these? Are you still looking at a heavy value add, or just more of a slow and steady? Maybe pick a few units at a time.
It's really hard. It depends on the deal, right? Like everybody, we would prefer a little bit more. I would say we're probably medium if you're looking at the entire scale. Like, we're not looking to go into complete decimation and bring it up from bones at this point, but we're not looking just at 1 or 2. Like, we do feel like the money's made on the front end. So if we can maximize that buy on the front end, and we know that we're going to go in, we know that it's cash flowing, or at least as close to it to start with, and build ourselves up a little bit from there. We've been really fortunate. We've had some great broker relationships, and we've been able to find some deals. It's getting harder, as with the change in interest rates and money being far more expensive than it used to be. That value add space and what that actually looks like, and the capital stack that goes behind it, and the corresponding return is tighter, is the best way to describe it. So if what we're looking for is something that's right in the middle, that we can see some value right away, and also we can see some value long term, and really build that out for our investors.
Yeah. And how does the deal sourcing look like? Obviously, you have a lot of broker relationships. I'm sure there's some off-market prospecting. In a given month, how many conversations are you having? How many deals are you underwriting? And,
Sure.
It's probably not a deal a month, obviously, to buy, but, how many, of all those monthly, how many a year do you end up actually, targeting to acquire if things go according to plan?
Yeah, I mean, we set numbers and goals for ourselves, but really it's based on deal flow and deal value, right? Like, we're not going to jump into it just to say, hey, we're going to do 6 deals this year, so we're going to, or do 12 deals this year, so we're going to have to pick one that's 12. We try to underwrite as many as we possibly can. Unfortunately, to your point, the vast majority of them come through they just don't work right now. So we're still in this really weird middle ground where, in a lot of cases, sellers still really want/need that higher price based on where they pegged it before everything started to turn, and where the money can actually buy it. So there's some fluctuations there. Just like everybody's talking about, there's some creative ways to do this, whether it be an owner carry, if you can get into some of that, or assumable loans, if they had a Fannie Freddie loan that we can jump into and assume. So those make sense. We've gone to a place where we have even BAs initially take a look at some of these, and we have trained some folks to take a look at what we're going through, so we're not personally spending that time. But I would say we get probably 3 a month at this point, 4 months that are worth a double look, and then maybe there's one in there that makes sense. But a lot of times, even with that, it makes sense if we're going back to the table and we're saying, if this works, then we can come to you at this. There are very, very few, if any, we've seen the last couple of months. They're just like, oh, this is a home run. You know what I mean? We found one recently, but we ended up having to walk away because not only is it financial, it's people, right? And I think that's a thing that doesn't get talked about enough. The numbers make sense. And I won't go into too much detail, but we found a deal that was insane. I think it was like $49 a door. And it looked great, but once we started digging in, there's a reason it was $49 a door, right? Like, it was all condoed out, and the HOA wasn't there, and the volume of lift that it was going to take. And the more we started to unearth what this was going to be, we just realized what we were up against. And at a certain point, you just get that feeling in your gut. It's like, this is not, even at this price, and even at what we think we can get, the risk is not worth it for us at this point. The risk isn't worth it for our people's money, because we think we can do a good job, but the volume of traps that we're going to have to step through, and honestly, the longevity and the volume of dollars we have to put into that, doesn't make sense from the return ultimately.
Yeah, sometimes the best deal is the deal you don't do.
Indeed.
Yeah, we have a situation in progress right now where it was an assumable loan, and the insurance quote that is being required by the bank is double what the previous insurance quote was. And luckily, the contracts are in place that there's a complete out if we cannot get a price adjustment for it. But we're not sure. The seller may just decide to hold the asset because they can hold it with the old insurance.
Yep.
At the same time, anyone else who buys the asset going forward is likely to have the higher premium too. So it's really just a matter of do they want to sit on it while it's a well below market interest rate currently. But
right,
if you see what's happening this week in the capital markets, even if the Fed does raise rates next week, the bond market for the 10-year, for the 5-year, for the 2-year is significantly lower than what SOFR is.
Right. Yeah, I mean, and again, I think it goes back to people too. So those are all interesting points. We've had the opposite happen to us as well. So we had a deal that we got into, and we were working with a banker, and it's interesting. We found this, and it was just an underperforming asset. We felt like the people that had it just weren't paying enough attention to it. So we were really, really interested in it. So we ended up doing a deal, and it was just before things started to turn, with a local bank. Amazing terms for a lot of reasons, and it's in Oklahoma, and we really like that space. But turns out that the bank president knew the property, because he ate lunch across the street from the property all the time. And he was really excited to meet us, and we had a great relationship and developed a rapport, and he was excited for us to take this property over based on who we were. But he created a situation where the capital raise had to be a much higher because he had a lot of these check boxes basically for himself, like, hey, I want this property to have, one of them was brand new siding, and not just brand new siding, but brand new, like, concrete, composite, like, top of the line, which in a lot of cases is great, but this property didn't need it. What it needed was replacement of some of the siding in some of the cases. So we ended up making a bet. We said, okay, we're going to change one side with what we think it needs to be. And we did that. We showed him. He's like, oh yeah, no, this is fine. This is great. In which case we were actually able to return some capital back to our folks almost immediately because we were really smart about how we had those conversations and understanding who this person was. Like, no matter the numbers obviously are incredibly important, but there's a human element that I think doesn't get discussed enough for this business.
Yeah, absolutely. Speaking of the human element, we both work with a lot of passive investors and are trying to, help those that have been in the same situations that we both were at some points in our lives and careers, being, having a W-2 or at least just a full-time active job. Who are your ideal partners and investors to work with for your real estate projects?
That's tough. I think people that understand, or at least are willing to learn what this space is about, right? Like, we love working with people that are coming into the space. Like, for me personally, a lot of the people who are in a similar situation to me that love what they're doing, but just need to spend their time doing that, or they're working 50, 60, 70 hours a week, or they're gone 40, 50 days on the road, and you're just dumping your life into this space. So I love working with people that have the ability to say, yep, we've got a little bit of money here. We'll work with you. I want to learn what you're doing, and let's go. People that are, not necessarily what I would call daily active, but who are really interested in the why, but that we can show some progress for the life over the long haul. And that comes in a lot of shapes and flavors. There's a lot of people that are in the real estate space that don't even necessarily know about syndication, right? There's a ton of, like, real estate brokers and a lot of folks like that understand even the nuances of real estate in general. But as soon as they learn, like, hey, I can pool my money with some other people and I can get a piece of a much bigger asset and all of the things that come along with the tax benefits, et cetera, it is so fun to see that turnover and taking them from being a new investor to being a pretty savvy investor over the period of time and start asking questions and even introducing them to other folks in the space, right? We're big believers in, if we do right by you, you're going to bring money back to us. But that doesn't mean that I'm the only game in town, or our asset class, or even real estate is the only game in town, right? So, for example, like, I know Hunter has ATM funds, a couple others, and the more that we introduce people to the abundance that's in this space, we feel the more people are going to come back to us eventually as well. Yeah,
that's such a great point. I mean, I say real estate is a team sport, but overall, just the need for sort of informal or as formal masterminds on wealth without Wall Street. Just there's a lot of great opportunities outside of that traditional financial system where there's just so many layers of people getting paid and fees to broker dealers, to advisors, and eventually that's why the returns end up subpar. Not that 8% annual is terrible, but I think real estate on average, especially syndicated real estate over the past 20, 30 years, is averaging mid-teens or higher with better tax benefits. So I'm with you on getting the word out. And I've also seen a lot of experienced landlords that own 20, 30 properties or buildings that just weren't really aware of syndications, weren't aware of investing outside of their backyard. And when they look at the taxes,
just the power of an SDIRA, man, like, that's the thing. It's like, even if you want to stay in some of that space, or you built up this thing, like, we have a bunch of people, and I'm sure the same way, who have built up a pretty decent volume that are just sitting on it. And then something like this happens and they just get decimated, or just, the legs cut out from underneath them. Like, hey, we've got a place, maybe not all of it, but we got a place where you can not only protect this, but you can grow this in a completely different way.
Yeah, the self-directed is super powerful, and I've somewhat neglected it because I moved to Puerto Rico, and there's some of our own tax benefits for that. But just connected recently with one of the prominent IRA tax attorneys, and I'm actually working on I had a sort of an orphaned 401k from my time in private equity, and now I'm going to be working with that because I'll be in Puerto Rico for a while, but I may not be there forever. Sure. But a lot of people don't understand the level of of options with especially the solo 401. If you are, used to have a corporate job and you've built up a $1 million 401k, and if you're self-employed, even if it's a small amount of self-employment, it could mean you still have a regular job, but you have a small consulting company. It's not necessarily about if you're going to go work full-time somewhere else. You don't need to be contributing tens of thousands to a year, but if you could just unlock that 7-figure 401k that you might have built up for 10 or 20 years, you could take control of that and make much better investment opportunities for yourself, whether it's through private lending, whether it's through syndications, whether it's even flipping a property yourself. If you are a do-it-yourself type of person and you have an interesting opportunity, the opportunities are really endless for for using your self-directed retirement accounts. And there's a lot of resources to speak to what you said to earlier. There's entire investment conferences dedicated to the self-directed IRA space.
Yeah, just getting educated about it, or even just starting to ask questions. Like, that's the thing. I think a lot of this is people find a niche, and which is great, or they find a lane. I was one of them. I dumped 15 years into events and loved literally almost every minute of it. But I also realized how much I was leaving on the table as well, right? Like when I started jumping into real estate, just like opening that door of like, oh man, there's an entire world over here. I can still be doing what I'm doing, but growing at the same time.
That's great. We could take a quick detour for a second. With all the travel you did, were you a points and miles connoisseur?
Oh, you betcha, man. You can't be on the road that much and not do it. Yeah.
Gotcha. What was your program of choice, or your best use of burning miles that you earned?
Well, I'm based in Denver, so United was always the hub, and they connected to Marriott, which was nice because especially after a while they started offering dual. They would basically match your status, which was awesome. It was a really nice way to go about it. But I've got plenty of friends who are far more deep into the points game than I was, and usually be like, hey, I'm in this situation. And there's a shout out to my friend Jason Hines. That guy would spend acres and acres of time, like almost to the point where I thought it was absurd, living his life to like maximize his points, man. Like, oh, well, I went to Bed Bath & Beyond and got this gift certificate, and then I went to Home Depot to buy the lumber, and I did this because it like gave me triple miles for this. Like, I'm not doing that, man. Like, we're already maxing as it was. So,
gotcha. I was somewhere in between. So, like my time in New York in private equity, we would go to all these conferences, and none of my coworkers or partners cared. So, we're allowed to book first class any flight over 5 hours. So, New York to LA, $3,000 a ticket. I'm spending $10,000 and expensing it the next day. And the thing, to keep this in line with that's typical, people that are listening to the show. I mean, it's really business expenses. If you're a contractor and you're spending $20,000 a month at Lowe's or Home Depot, using the right card, it could unlock 1 or 2 amazing vacations for you and your family a year. And
very much, yes.
That's the biggest benefit for me has been the experiences. So I ended up doing an executive MBA, and I flew back and forth to Hong Kong like 6 or 7 times, almost all with points. I'm going to Singapore next month. So that's actually within 10 minutes of the longest flight in the world. It's 18 hours, but I'm using 90,000 Amex points that I transferred to Air Canada, and I'm flying direct in business class 18 hours. And the thing about an 18-hour flight is there's time to get drunk twice.
Well, if you're on the plane that long, you need the space. You're a big boy, and so am I. Like coach is no place to be for 18 hours, so that's the truth. Yeah. Well, you mentioned that. That's the same thing. We use them for our life, right? Like if you're not maximizing what's available to you, I met my wife living in New York, and so I'm from Colorado. We live in Colorado again, but obviously family is very important, and them knowing our grandkids is super, or their grandkids, our kids is super important. So the ability to just say, yep, no problem. We're going to get on a plane. Oh, we're doing family vacation? For sure. We'll be there. And being able to maximize our points and be able to utilize that and not go out of pocket is incredible for us.
That absolutely. And maybe if your friend wants to talk points and miles at some point, we're overdue for another points and miles show. So maybe I'll have him on and we can go fully deep into the.
I will set that up.
All the arbitrages. So obviously neither of us have a crystal ball, but as we record this, we're in the middle of the major banking crisis. Rates have moved a lot. Is economically, how is this affecting what you guys look for as far as kind of what your entry cap is, what interest rates you look for, and even the future exit strategy on where you think, without a crystal ball, like rates may be, at least for your risk tolerance on where you're comfortable underwriting a deal. Yeah,
I mean, you mentioned it. Like rates have slid so much, and the arbitrage between cap rates and where we're getting our money at has obviously changed quite a bit. So we have to get a little bit creative. We have to be smart, making those deals work. I mentioned in the beginning, I'm not the only person that said this, I'm sure we didn't invent it, but making sure that we're asking the right questions, finding the right partners, but also, is there the ability to assume? Is there ability to be creative about the financing? Is there an own and carry situation? There's a lot of really unique ways to do this, and we're just going to have to be smarter about how we have those conversations. It hasn't changed a lot of our criteria, because I think our criteria stands up to quite a bit of what we're seeing, and on purpose, right? So you can get a little bit more friendly with, and flirt with some danger when the water's in, but now we're seeing a lot of that change. So how we ask, how we have this criteria, how we set the deal up, how it pencils is all on the front end. Well, again, we make our money on the buy. So it slowed the deal flow down a little bit. It slowed, the volume that we're seeing they're going to pencil out. It's frustrating at some certain points for sure. But the way that we put these deals together, we've always been conservative. We weren't the guys promising 30, 40%, but that was never us. So we're still on our lane. We'll see what happens. I think it's really interesting to see this inflationary period. To your point, like, is the Fed going to raise rates? Are they going to, what actions are they going to take, especially in light of, some bank failures? But that's also what we love this space, right? Like, if you're, typically speaking, and I know I'm painting with a very broad brush, but multifamily typically increasing fairly alongside the CPI. So if we're talking to people and people are in a space, say I'm a producer still, I've got my family and I'm just producing, where is this going? I'm maybe getting a little bit nervous. We're seeing interest rates go through the roof. We're seeing inflation go through the roof. And I say, hey, take a look at where you're investing. With this, you put some money into this multifamily. Not only is it protecting, you just keep that money in the bank, you're burning money, essentially, especially as inflation goes up. You take that same money, you put it into a multifamily asset, which grows, again, broad brush, but commensurate with CPI. You're not only protecting your capital, but you're growing your capital. And those are the two things that I think make the most amount of sense to people. So deal flow, all those things, we just have to do our job as syndicators. We have to do our job as sponsors, ask the right questions, make sure we're securing the right amount of debt, make sure that our capital stack is appropriate, make sure that we're prepared for what we think we're going to do and then some. But if I can go help people grow their money instead of just letting it burn in a bank account, I'm psyched.
Yeah, that's an extremely, extremely powerful point, and that it's something I was talking to one of my mentors recently as well. Someone, one of my investors said, "Well, treasuries are paying almost 5." And it's like, yeah, for 9 months or 1 year. If you look at the 3 year, it's down to 3.5. At the same time, getting into a multifamily syndication where you may have 5, 6, 7%, 10% on some deals that may be more stabilized with low debt, first year cash flow plus that appreciation plus the hedge against inflation. It's really powerful. And the tax benefits, you don't get the tax benefits, at least from treasuries. Maybe there's some tax-free municipal bonds, but those aren't paying the same amount anyway. Right. You mentioned the CPI and rent growth, and I've gotten some articles sent to me recently about real estate. It usually is residential focused, but I've seen some articles of rent is dropping in Texas or in certain metros are leveling off. But what I found is the data is often the higher end units, and you focus more on Class B, C, workforce housing. Is that right?
Absolutely, yeah.
Yeah. What are you seeing as far as your monthly rent growth? Are you seeing any pullback, or is it still in that market where there's an undersupply? Is it still, increasing?
We still see an increase as of right now. And knock on wood, it's mid-March, and again, we don't have a crystal ball, but we also have built it in the sense that we're really comfortable where we're at, and even in this case where we have to hold, we've been conservative in our numbers, and we think that we can do that. Like it's about controlling cost as well. So it's not just about rent growth; it's about controlling your cost into that as well. So, we had same thing. Like we've had properties in the past that we hit our metrics almost immediately, but our costs were just so expensive to get there that it kind of was a wash. So looking at what we see in the future and picking markets that we think are going to be increasing, and for a reason, right? Yes, you could say, over entirety of Texas, you may see a rent drop, but what does that actually mean, and what asset classes does that actually incorporate with? Once you start getting really niche, you say, hey, in this neighborhood, in this city, in this asset class, adjacent to X, Y, and Z employers and X, Y, and Z hospitals, and on this transit line, like this is where you can get way into it, and that's how we look at it, right? So when we underwrite a deal, we start at a really macro level. Like we start and just kind of keep zooming in. Like, do we like the market overall as an MSA? Yes, cool. Do we like the submarket? Do we like this neighborhood, and they, what are all these other things around it? And it's a really simple way of going about it, but almost nobody talks about that. Everybody's like, I like San Antonio. We're in San Antonio. There's parts of San Antonio that I don't want to be in. Same thing, like we're in Little Rock. We love North Little Rock. We love where our property is situated for a lot of reasons. But would I just buy any property in Little Rock? Absolutely not.
Yeah, very, very, very valid points. I completely agree. And I think encourage everyone just don't watch the CNBC headline and assume that that is the law for real estate markets. Real estate is really local, and it's also based on just the individual asset classes. And Class A rents will be the first to drop, but there is a systemic shortage of workforce housing. And part of the reason that I invest in the space with various groups is that you cannot build the type of stuff that you buy and that I invest in. You cannot build it for the cost. It's well below replacement cost, and it's unlikely that anyone will even be able to build because of the cost of construction materials, supply chain. You just can't, if you're building, unless you get credible tax incentives, you can't build workforce housing profitably.
You can't build it, and honestly, some people can't buy. I mean, we talk about inflation, and that's why I don't want to say it's unfortunate, but just being able to see what's going to be beneficial to you with the cards you're dealt, right? I think that's the biggest thing, is that the reality is that we're going to have ebbs and flows. This is not going to be the last time that people are having this conversation, and it's certainly not the first time that people have had this exact conversation. So dealing with what the cards you have in your hand at that time. Inflation is going to go up, or is going up, I should say. We don't know that it's going to keep going up, but as it goes up, we say, cool, so we're in an inflationary environment. What's the best play for us? And I still think multifamily is there, because as inflation goes up, it becomes harder to build, and it becomes harder for people to buy, which means both of those things in my B2C class workforce housing, that those are good things for me and my investors, because I know that we have a place for people to come. It's a really nice place to live. We work super hard to make sure that we're providing quality housing for people, but they're going to come to us because that's affordable to them, and it also allows them to continue living their lives.
Yeah, that's great. What advice do you have for somebody who's pretty much only been in the stock market and wants to kind of start dipping their toe into syndications, or alternative investments, or passive investments?
I mean, this is a great place to start. Like, listening to podcasts like this, finding out a couple of people who do it, and ask questions, right? I think that's the thing, is that the real estate market also isn't for everybody. It is illiquid in a lot of cases as compared to, say, a stock, right? Like, if you are somebody who needs to be liquid all the time, or you believe that you need to be liquid all the time, might not be for you. But I would ask the question why, right? Find some people who have been in the space before, or find people who are a couple steps ahead of you in the game, and just start asking questions. That's the biggest thing. And get educated. Find some people that can help, and find somebody that's willing to say, you don't have to invest with me. Like, that's the biggest thing for me, is like, if you're going to find a whole lot of folks that are going to perk their ears up as soon as you say, hey, I'm going to get out of stocks and I want to get into real estate, I've got the deal for you, right? Come with me. We're going to show you everything we got. And that might work for some people, but if you find somebody like, let me just show you what's behind this door, you make some decisions, ask some questions. I'll give you all the information I have. And I'm not, I'm by no means the most experienced or smartest person in syndication. But I'll tell you, I don't know the answer to that question, but I'll go find out. Or I'll find you somebody that knows that answer better than I do. And I think that just getting involved with some people in that space, there's plenty here for everybody, man. And honestly, the more you can help somebody just dip their toe in, the better you're going to be.
Yeah, that's great advice, and it'll become fun too when you go to a conference and you meet hundreds of like-minded people that have all, they're all doing different niches. Some are more active operators, some are more passive investors, but meeting real people that are having success in the space, for me, was always the best way to really get comfortable quickly. You can buy an infomercial or buy a bunch of courses here and there, but nothing substitutes just meeting real people that you could have a steak or a drink with, and hear their story and hear their successes and their challenges. And real estate is a team sport for sure.
100%.
Awesome. So Ben, how does everyone get a hold of you?
Yeah, I'm active on LinkedIn and on Instagram. It's Ben Nelson 303. You can find us at wildoakcapital.com, and feel free to reach out to me there as well.
Great. And we'll put everything in the show notes as well. Ben, thank you so much for coming on. Had a great time and great chat, and look forward to maybe doing some deals in the future as well.
Indeed. Thanks, Jack. It's good to see you, man.
That's all for this episode of Alternative Investor Mastermind. Now that you know the many alternative opportunities out there all up for the taking, you can finally become ultra connected and ultra wealthy. Get more valuable advice from the experts by subscribing to the show at AlternativeInvestorMastermind.com. Become a winner in the world of passive investing today in alternative investment strategies. Thank you for joining us. Until next time.